Good afternoon, everyone. Welcome to Short Verticals. Brett Crowther back again with you. Good to have you aboard as we look at what happened to the trades we did last week. Remember, last week we did those like 1 day till expiration. We'll look at what happened with some of those, and then we're going to get into some other trades. Will also be very short time, kind of a duration for Short Vertical. So we'll look at that. But we want to welcome everyone aboard. Will, Duke, Richard, how you doing? Kevin, Jack, Robert, oh, so many more. Welcome aboard. Good to have you. We also have Cameron May here taking care of the chat. So give him a shout out. A good friend of mine. Been working together for many, many years. Speak Truth, welcome aboard. So before we get into it, though, let's cover a couple of disclosures. So give me just one moment to cover these. Do remember that options do carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation. Paper money is for educational purposes only. Short options can be assigned at any time, regardless of the situation, meaning if they're in or at the money. Investing does involve risk, including the loss of principal. Past performance is no guarantee of future results. And then we got some Greek definitions for you. Also, do remember that stop loss orders, we don't tend to use a lot of them in this class. However, anytime you're looking at stop loss orders, do understand that they're not guaranteed to be executed at the price you set them at. And there we go. So got those taken care of. Let's go out and look at our Thinkorswim and just kind of talk about the general market, what's going on. And, we had the Fed announcement yesterday, right? They come out, what was it, a 6-3 split, something like that, 7-3, somewhere around there. I think there was three dissenting that they would, but as far as the overall decision, they wouldn't raise rates, right? They'd keep them where they were at. And, how'd the market react? Well, kind of sold off. We did have the PCE come in this morning. That's one of the Fed's favorite inflation gauges, and it was less than expected. It was supposed to be at 0.2, and it came in at 0.1 month over month, and so it wasn't real strong. We also had GDP come in. The GDP was the advanced GDP was lower than expected as well, and so had a couple economic reports that weren't quite as strong as maybe some traders would have liked. The market, however, was up pre-market and continues to be up. And so overall, they're looking at that as favorable, along with some of the announcements, earnings announcements and others that are coming out. But so what are we seeing on the chart, right? So we've talked about this, how we're kind of going into the sideways action, how we're seeing some consolidation in the overall upward trend. Looks like that has not changed just yet. Now, yesterday, let's zoom in on this. And let's just kind of take a little bit closer peek. I'm going to try to get this spot right here and really look at what we have going on, especially yesterday, because yesterday was interesting. Now, this is one of those situations where, yes, if we just take a look at that day alone, you'd say, okay, look, we broke through support. This is opening up the door for downward action. That is true. We'll extend that to the right. So, whoops, to the right, I should say. Extend to right. There we go. Not left, right. But so right here's what I'm talking about, where it looked like it broke through not only looked like it did break through the support level that we had, and this would indicate that while it was a symmetrical triangle, which often is consolidation in the, from the previous trend and should typically break out in the direction of the trend. This time it broke down, and so that would open up the idea for more downward pressure, downward action, right? But what did we see today? So we had kind of a newsworthy day yesterday, and then today we see it kind of bouncing back up. So it's going to be interesting to see where this one closes. If this can actually close back inside that, then it could just be a knee-jerk reaction to the news announcement yesterday, which is kind of I don't want to say anomaly because it's what we expected in the market, like to have a news reaction. But the point is was the reaction just knee jerk, people just being a little bit overzealous on it, maybe taking too strong of a position early on and not really holding that through. All right, so keep an eye on that. Oh, welcome aboard, Bilberry. Acme, yes, welcome aboard. So I'm curious to see what your thoughts are. What's your take on the market? What are you seeing as far as your overall outlook? Um, just kind of how it kind of gauges with what we're seeing here on the chart, if you're kind of taking the same stance or not. But let me know what you think of that. But right now, kind of back, it's regardless, even if it's breaking this, it's still to actually get outside of the consolidation. I mean, we need to see it kind of break below some of these areas in here, somewhere in this ballpark, because you almost have this, even though it's winding up. And so we do have that symmetrical triangle. You can also see, though, how it's just been kind of almost going sideways since we're talking early, May. So we got May, June, July, basically 3 months, just been kind of channeling sideways, meaning if you got in somewhere here in early to mid-May, well, it's still the same spot, right? It really hasn't gone anywhere. It's neither up nor down. It's still the same spot. So that's what I'm talking about, that we haven't seen a lot of directional action to the either side, even though it has shown us some potential moves to one or the other. So that's where we're sitting right now. Let me just check, make sure I'm not missing anything from what you're saying. It doesn't look like it. Okay. All right. So I'm not going to take time to go through all the others. I know a lot of the other coaches go through the other indices, and I don't want to take the time to do that. I mean, it seems like you can catch at the beginning of any other class, right? Acme says, "Hey, nice at the midpoint of yesterday's candle holds." That's a good point. In fact, actually, let's bring that up because from a technical perspective, that's a very good point. And what we're looking at here is this is a pretty good sized candle right here, a nice long candle, and often the middle of that candle can act as an area of support or resistance. In fact, let me just back out. I thought there was one a little bit earlier that we could, where was it? Maybe it wasn't here. Maybe it's not. Okay, I thought there was one here I could show you in quick order, but I guess not. But so what we're talking about though is, yeah, this candle right here, the very large candle, often the midpoint of that can act as an area of support and resistance. So this is what he's saying. She's saying, I can't remember who said that. But anyhow, this could, if that could be an area of support and resistance in this candle, you can see it came down, did kind of hit the midpoint and bounce back up. And so that's another thing to be looking for in a very short-term technical aspect, right? Is will that midpoint hold? So keep an eye on that as well. Okay, so let's do this though. Let's go back and look over some of the trades that we placed last week. Because if you recall, we talked about, I was answering some questions about trading very, very short time frames, these 1 day till expirations. What are the pros and what are the cons about it? And if you're interested in that and missed that, go back and check out last Thursday. So that would have been Thursday, the 23rd, July 23rd, the class that we did then, and it'd go through a lot of detail. But we placed a couple trades on that, and really the pros and cons were this. The pros were the potential money to be made could be made in like 24 hours, right? Very quick. The downside is the return to risk ratio was really low. And so it basically had to go in our direction or we'd lose the money. There's no time to really recoup or wait and see how it plays out. If it kind of goes against us a little bit, it's kind of an all or nothing thing. And so let's go and look at, let me actually get off of that. Let me get back to my pointer so I can change things. PANW is one that we had. And this one, I didn't have this one spelled out. This is on the 23rd. Is that right? No, it was MU I'm thinking of, not PAMW. That was our other one. MU, sorry, here's what I wanted. Yep, here we go. So MU, let me remove these drawings here. Right, here's what we want. Okay, so this one, we're looking for a bullish move here. We need it to be above this level, by this time. So, and it can go higher than that, right? So we sold the 97.65 put, looking for it to go up from 97 right here. And, at the end of the day, it actually had, but the next day, whammo, that thing dropped down and dropped down really hard. That was a big move. I mean, the range on that thing was what, $63? So it dropped hard. And so that one, and I guess we got filled. I put it in for $1.45, but when I went back and looked at transactions, I think it said we got in at $1.77, so we got a little bit more than we expected. Just kind of going back to the idea that you don't always get filled where you want. You can actually get filled at sometimes, if you put it in the market, there's our potential. It's not really common, but potential to get filled at even a better price. But that's what happened here, $1.77. That left us the risk of about 323, and then this one went fully against us, and we took a loss on that one. But looking at some of the other ones, NVDA, looking at NVIDIA, where are my, there we go. It took a minute just to populate those. So NVIDIA here, we're looking at this up against resistance. You can see where we had the resistance drawn in here, price action. We were right here, so we're looking at this is resistance, price action dropping down, looking for it to stay below the 212 level up in here for the 1 day, and obviously it did. And so that one, just next 24 hours, we collected on all these. I only did one contract, right? So we didn't go in and do some position sizing, which that could have impacted, right? How many shares that we entered on. I was just doing this more as a demonstration of the of the concept rather than going through and doing these, hard and fast truths or plays with all the details behind it. So this one played out real well, in 24, 36 hours roughly, is what it took to collect the gains on that one. But the gains were very small, right? So we still had a lot of risk. We only pulled in about 36 cents on that one. Apple, let's see, also Visa. Let's see. Let's get this one come up. Visa on this one. Where is, oh, it's way back here. Come on, you. Let's get you over here. There we go. So on this one, we sold the 347.50, 345 put spread. And so we are looking for it to be above. So this is a 23rd right here. This one goes a little bit long. We only needed it here. And so we needed to be above this line. Obviously it did. And so we walked away with the 44 cents that we were looking to collect there. And this is where it was nice, where it was a little bit down near a support level, right? And so when those things can play out, and I also brought in another concept that, it's nice to actually have earnings just around the corner. So if we're doing this like on a Thursday, looking for a Friday expiration, it really is actually nice to have the earnings announcement the following Monday or Tuesday. And the reason being is because at that time, the stocks in general, this isn't always the case, nothing's 100%, but in general, the stock movement tends to slow down. The options can change wildly, right? Volatility, implied volatility, so that's something different than the stock volatility. The stock volatility tends to diminish getting into earnings because now the stock traders are starting, kind of sitting back waiting to see what happens, while option traders get active because now they're trying to speculate and there's, hedging and all the things going on. So option trading can go up going into earnings where stock trading can often go down. And it's good for the strategy for option trading to go down or for stock trading to go down because we're looking for basically just price action, stay where it is or just don't go anywhere. And that can be a benefit. But anyhow, this one worked out, made the 44 cents on that one. Another one that we had was Apple, AAPL. Let's zoom in on this one. So here we go. Again, looking at a level of support. We had some short-term old resistance right here, short-term support right there coming down, looking for it to bounce off that, just stay above this level. And sure enough, it did. And so it was again, basically a one-day trade. And next day it expired, walked away with the, what did we get on that Apple? 48 cents on that one per share. And so $48 per contract, right? So there we go. So did I cover them all? Yeah, I think I covered NVIDIA, right? I think I started to bring that one up, but didn't complete that one. No, I didn't cover this one. Let's do NVIDIA was a bearish one that we did. And on this one, we were looking for price action to be below 212 and a half. And so looking for, the price action to drop down off this resistance. And again, these are some nice setups, really, where we see price action really close to a support or resistance, in this case, resistance bouncing off that, potentially heading down, and then just boom, boom. And even though we had the range, you can see it was nice to get this kind of smaller days in here. And then, it just closed out for, the expired worthless, right? We walked away with 36 cents per share on that one. So I think this kind of is a good example of, again, those pros and cons. We had most of them go well. Most of them go well, but then when they do go against us, the loss can be heavy. And so that's a trade-off, right? Okay, thank you. I guess I covered NVIDIA. Let's see. Fed decision 9-3. Thank you. I was trying to think, it's 6-3. I was thinking there's a 9. So it's 9-3. Thank you. There's 12 total. There we go. 3 recommending a rate hike. Amazing with the USA being in conflict in the Middle East. On the other hand, investment capital coming into the US. Yeah. And that's one of the things is if you get in, I used to teach Forex for years and years. And one of the big things about that is, the US dollar being a safe haven, oftentimes when there is conflict or there is concern or financial instability, right, that can drive money in the US. And so you can see bonds benefit, you can see equity markets benefit. Another time that can happen also is kind of rate cuts across the board. When you see rate cuts out there in the world, and at least rates are relatively higher than they have been, right? I mean, it's so funny when I hear people talk about these rates are so high, and I think, I first bought my home I was glad to get 8%, and I had excellent credit, you know, but it's just rates were higher than that. When my parents bought their home, they were glad to get 12%, you know. So if you remember back in the 70s and early 80s, rates were a lot higher. So it's funny when I hear my children think, oh my goodness, rates are like, 6% and 5%. I'm like, wow, well, you don't, you have no idea. But when rates drop and there's no return around the world, money can also flow into the US. And so there can be more than just even what's happening in the US as far as, earnings announcements and stuff like that, that can play a role in the overall, uh, kind of the flow of money, right? So monetary policy can actually drive money flow throughout the world. And if rates actually do increase, well, it can be some concern for some companies, especially small caps, because they borrow so much. It can actually benefit the U.S. with more money coming in overall. And there's just so many things at play, but just kind of keep in mind that's one of those factors that play into the traders' minds. Okay, I think we're good with that, right? Another. So let's jump over to what I wanted to cover today, though, because so I did that, based upon what you guys were asking and some of the comments and stuff. And by the way, thank you for making comments. Thank you for, in fact, I had a couple comments on my X handle, and do follow me on X. Brett. All right. I was going to show you my the YouTube Shorts, and so on the YouTube Shorts. Um, I was going to cover some of the price patterns that I'm going to bring up here in just a minute. But the what was the other thing I was going to say about that? Follow us on X, and on X, um, some of the comments that came out of that was asking about these short-term options. And another thing is someone said, "Hey, can we go, a little bit longer?" And we can, right? And so I want to go over kind of the pros and cons about trading not just one day till expiration, which we did, last week, but trading how about a week till expiration? Instead of going out, 3, 4 weeks, 5 weeks, how about, just 1 week? Is that feasible? What are the pros and cons of that? And so that's what I want to cover today is let's look at short time frames, but just give it a little bit more room. And there's some interesting setups, there's some interesting situations here. And so let's go into that, shall we? So I was looking over some different stocks we could look at. Oh, you know what? I need to hit before that. Let me hit before that is there were a couple stocks that on another comment that I made looking at potential plays. Not this one, nope, Meta. Meta's one. Why is that dot not going away? There we go. Is I mentioned dead cat bounce, and again, I want to show you those price patterns. Go to YouTube, go to YouTube Shorts, and there's I've talked about dead cat bounce in one of those shorts. But here we have a gap. You can see this gap right here. Now Meta does tend to gap, and so just kind of keep that in mind that some stocks have a personality of gapping quite a bit. But let's just kind of come back here and look at this right here. I think this is a good example of what I'm talking about. And so what happens is price action was kind of dropping down, but then it came out, had the earnings announcement right here. And with that earnings announcement coming out here, price action gapped way down here. Now, here's the psychology behind this. Investors are looking to make money, right? So they're buying in 675, 700, 725, and 750. And then overnight it gaps down to 650. And so you have some people thinking, okay, hey, okay, it's down quite a bit, dang it. Okay, let me just hold on. And when it gets in, if I buy it in at 700, down at 650, maybe I'll just wait for it to get back to 700, maybe take some profit, right? And that's what a lot of these traders or investors that bought in around here are possibly thinking. But then what happens is price drops down. All of a sudden they're thinking, man, now it's down to 575. I was hoping to get out at 700. Well, forget that. But I did have an opportunity to get out at 650. Now, when it's at 575, 650 looks a lot better. Initially, that was a horrible number, but now it's looking a lot better. And so when price action comes down, they're saying, if I could just get back out at 650, and there we have the rally back up, it gets back to that 650-ish level. And that's where some of them had all this mindset saying, please just get back up to where I could have been. This is like a second opportunity, right? And they take their losses, actually they cut their losses, walk away, but that selling pressure pushes it down again. And that's the idea behind the dead cat bounce. And so that's what we're seeing possibly over here. It doesn't play out 100% of the time. You can see there's a gap right here that just kind of did. The idea is it should go at least back down or even lower than the previous low. This time, let's do this. Let's get rid of that and come back and draw a line in here, right here. Well, let's zoom in on that. Let's zoom in on this area. So we can see also right here, let me get a little bit more space in there. Here's the gap. It did in fact come down. It just made a really quick low, rallied back up to resistance and went lower again, right? And then actually kind of came down, made almost like a very short head and shoulders pattern, if you will, like right there, an inverted head and shoulders, deeper low right there, boom, popped up around the distance up there. In fact, getting back to those shorts, I just did a short on inverted head and shoulders, and so go and check that one out. Again, those shorts are like 3 minutes or less. So go to our Trader Talk page. On there, you'll see where it says shorts. Then you can just grab them, and maybe I can grab this at the end. But also, hey, and if you're not a subscriber, please, do subscribe. Another thing is if, this material is good, please hit the like button. The like button just helps get this out there and make more awareness of this material. So that's one to keep an eye on. Another one to keep an eye on along that same theme is Tesla. Now you can see this one's a little bit more developed, right? You can see here that Tesla's already made the gap. It's already dropped down. So once again, you have the traders buying in at 420, 397, 380, whatever in here. It opens one morning now at 340, right? And then wham, it goes down from there. Again, those that could have got out at 340 that are now holding on at 300, 298 are thinking, man, 340 looks a lot better right now than 298. And so we'll watch for that to see if we get a potential rally back up to that resistance and then see where to go. Now, a question was asked on X to me saying, hey, well, what about that rally? Could we possibly play the expected rally that comes back up? Possibly just understand this. It's a very, very aggressive play, right? Because there's no guarantee it is going to rally. It could just kind of roll over and drop back down. And so while it is there, and that's kind of the idea, it's almost like that whole idea behind, is this a double top? Well, it's not a double top until it develops. Or is this a double bottom? It's not until it develops. Is this a dead cat bounce? It potentially is, but it really isn't until it fully develops. We come up and see it bounce off this and roll back down. And so we're kind of playing this hypothetical, this is what it could possibly do. And so while it could potentially, play that, it is very, very aggressive. So keep that in mind. All right. Let's see, make sure not missing anything. Okay. All right. Now let's do this though. Let's go out to let's go Google to Google. Okay. And so looking at this, it looks like what we have here is the downward pressure, right? Can we all see that? That had a nice rally, came up, came back down, broke through the 38 fib, broke through the 50 fib. It looks like it bounced off the 62, but kind of broke below it a little bit. It looks like the fibs are not really holding a support. And it did run up. Let's delete these fibs. Now that we've seen those, let's remove those. And let's draw a line right here. And check this out. There's this just general area right here of resistance, right? Hit resistance, chopped around it, found some resistance that held up for a week, came down, acted as support, broke through it on the gap and rounded back up. And it looks like it's bouncing off that. And so potential bounce off this heading down. And so what about if we take a potential bearish play on this, right? And so let's go see what we could potentially do with this. Now let's go to the trade tab. And since I have them linked, like I have this one as red, just like on the chart, I have that as red. And so it already populates with Google here. And we're looking at, the possibilities here. Days to expiration, 1, 4, 6, 8, 11, 13, and so forth, right? What we're going to be looking at is about a week out. So let's look at next Friday. So this is going to be August the 7th. And so that's 8 days away. And we're going to go to the call side. Let's look for something. This might be a little aggressive. We can decide how aggressive we want to be. If we want to go with a little bit more money or a little bit more probability. Now let's go for, since we're at resistance, let's see, because we're not too far off that. Let's see if we can get a bounce here, because we can get the most out of it. If it makes a move to downside, being a little bit more aggressive since we're at resistance is going to give us the most, more, not the most, more return, but also, we're dropping our probabilities because we're looking at this delta of a 40 and using that as approximation for being in the money. It has a 40% probability being in the money, which should also inversely state that we have a 60% probability of being out of the money. And so higher probability trade, let's go ahead and sell this one. We'll go ahead and click on the bid, and then I'm going to hold down I got to scroll back up here so we can see this. We're going to go ahead and sell the 337.50. We're going to buy the 340, hold down the control key, hit the ask on that one. And let's lock that in just to make math easy here. All right. So what we have now is a 337.50, 340. So we're expecting price action to be below 337.50 by next Friday, right? And then if it climbs, we're going to buy the 340 to help protect us. We're going to get 95 cents on that. Right now, what's the spread on that? Well, the spread on that is 250. So the 250 is the max we could lose minus the 95 cents. And that's going to give us a $1.55 risk. And so actually, what do you think about that, risk reward premium? 95 divided by the 155. Because we're getting is that right? 61%? Yeah. Okay. What do you think of that? I'm curious. I know there's a little delay here. I want to see your thoughts though. And so let's go ahead and actually place this trade. And I'm going to talk through it and look at some other things as we do this, right? So we'll go ahead. Let's see. Yeah, I mean, we're probably getting a little generous here, trying to ask for 95 cents on. It's good for paper money, but on a live account, it's a little bit more difficult to get that fill. So looking for us to make 95 cents or $95 per contract, risking, the 155 on that. Go ahead and send that one off. All right. Yeah. Okay. Good risk ROR. I like it. Okay. Okay. Interesting. All right. Now, so here's the interesting thing. Let's do this. Let's go out and look at a little later one, like August 21. So this might be something more common, right? I mean, this is still maybe on the short end. But what if we did, I'm just curious to see, what if we did something similar there? Because we just talked about doing the 337.50. Let's sell this one. Let's duplicate that order. All right. Yeah, I gotta find it again. Hold on. Gotta hide this. Then we hit the 337.50, hold down the tree, buy the 340. What are we getting there? $1.12. And so this is interesting. So we're getting $1.12. It's versus the 95 cents, but we're getting 2 weeks more, right? And so what I think we can see here is there's not a lot more premium that we're bringing in. We're adding an additional 2 weeks to it, like meaning we have to wait 2 more weeks for additional, what is that, 17 cents, you know, about 25% more, right? And it's interesting to see how those play out. And it's not a bad thing to actually kind of play around with a couple different strikes or expiration cycles. And sometimes we can do it pretty quickly by just, selecting, whoops, what did I do there? Did not want to do that. What did I hit the wrong thing? Oh, did I hit, let's do, so it's calls. I'm going to show you another one. I don't know what I did there to change that. I just want to change the month. But anyhow, let's go ahead because I have a couple of these I want to show you. So let's take a look at another one. Amazon, MZN. So looking at Amazon. So Amazon looks like it's holding at a support level here, bouncing off right there. Coming down. There we go. There it got filled. Okay. Bouncing off a support level, possibly rallying up. Now, the overall trend a little bit to downside. That could be a little concerning, right? And possibly, are we going to have some short-term resistance right there? Possibly. So this is going to be aggressive play. Now, this is after the earnings announcement, right? Oh no, it's today. Oh no, I thought we were past it. Never mind. Never mind. We're not going to do that. 7:30. Yeah, earnings estimate after the call. So that one's a little too tight. We're not going to do Amazon. Now with that in place, that kind of go against the whole idea. Let's go to IBM. Here we go. Now we're past earnings on this one. Let's move this up so we can see what's going on here. So IBM almost looks like that whole dead cat bounce we were talking about earlier, right? You see that? See where price action had that gap right there? We gapped down from about the 290 all the way down to 228, dropped on down to 202, rallied back up to 230. And once again, those who were buying in at all these prices, 280, 290, 300, but when it gapped down to 225, they're like, oh, darn, I'm not going to, I'd like to get some of that money back. And then it drops down to 200 almost, or even 199. They're thinking, you know what, 220, 230 sounded good, right? And so they look to possibly sell when it comes here. So how about we also look to get in on a bearish play here on this rollover right here. And so let's go check out what that's offering. What is our resistance, just out of curiosity? Around that 227. Okay, So we're up around that 227. Let's go back to that same time frame. We're going to look at 1 week out. And with this week out, we're doing a bearish play here. So we're going to go, what's our deltas at? We're going to use that delta as approximation. 227. Let's try it again. It's even kind of a little bit better. Probability we're about 36% in the money. So, roughly a 75%, 65%, should I say, probability being out of the money. We're using that as approximation. So let's go ahead and sell this one. We'll sell the 227.50, and then we're going to go ahead and buy the next one up to 230. And so kind of placing this one together, what are we getting on this one? 72 cents. Okay. So we got a 2.5 wide spread. We're getting 72 cents. Let me just lock that so we can do our math and not have that bounce around. Let's move that down to 70 cents, just make it nice and clean. All right, so what do we have? 250 is the width of the spread minus the 70-cent credit means we have a risk on that of $1.35. And by the way, you can just actually hit confirm and send, and a lot of this will come up, right? So there's a $70 that we could possibly make. Next loss, did I get that right? No, I didn't hit that right, did I? Hold on. That's good to check. What did I do on that? Clear that. 250 minus 70 should be 180. Yeah, there we go. All right. We got the 180 in there now. So basically it's the same thing, right? Here's our 70, here's our 180. That shows us what we could make and lose. And then that risk reward, hold on, I got to clear off that so I can click on this. 70 divided by the 180, looking at the risk reward, is 38, about 39%, right? So still, not bad, because that's often what we're looking for is that 30 to 40%-ish when we're looking at something with, 3 or 4, 5, 6 weeks to expiration. And so we're still getting a fairly good premium especially for the amount of time left till expiration. And so let's do this. Let's go ahead and send this one off. Actually, I want to do something else. I want to look at, before I send that one off, let me do a little bit of analysis on this, right? So I'm going to right click on this, going to analyze this trade and just show us what's going on here. What else do we have here? Looks like we got a couple things going on. All right, here's our trade. Here's our trade right here. So this is a bearish trade, remember? So we're actually making money as it goes down. And so this is where at 230, above that 230, we're hitting max loss. Below 227.50, we're hitting max gain. And somewhere in between there is where we're making, some combination of either making or losing some money, right? And then you have also the probabilities, but the lighter gray is the probability it will be between wherever this line is. And so either, 49% of being above, what is that, 221, and 58% of being below that. Now we don't necessarily want 221, we can move that over and say, okay, what's the probability of being right here, which is our break even, or even if we wanted to look at, being at max gain here, right there, which is going to be the 227.50. Well, we're talking about a 60% probability of being below that and a 39% probability of being above that. And so now, I think this range, though, is a very important one to see. And this is what I really like about the Analyze tab, is being able to see the expected range the price action can move. And so, again, it's fine where it is right here. Again, we need to be below the 227.50, and then right now it's at 221.85. And so that's all good. It's just as long as it stays down here or, goes lower, right? But there is a possibility, there's always a possibility it can go against us. And this one is kind of giving us the expected range that could possibly go up. Now, here's the deal. So what is the difference between this? And let me show you, actually, let me add one more trade before we send this one off. Let's go back to that trade tab. So we have this one that we already talked about, right? Now let's go ahead and send this one. So everyone remember these numbers, right? So we had, this is the August 8th, 7th expiration, sorry, it's 8 days away. And this is the 227.50 and 230 for, what are we getting, 70 cents. Okay. Now let's go on and look at like a little longer, like maybe what the August 21, is that what we were looking before? And just see, this is what I was trying to do before. It's gonna click on this and change this to like August 21. And that should, if I unlock it, change it. Now look at this. That changes to 82 cents. And actually I brought the other one down, so it's more like 70 versus 80. So I think this is interesting. again, going out several more weeks, but we're not getting a lot more premium for this. And I'll be honest with you, when I was going through the math earlier, there was a 2 cent difference. And so it can also vary depending on what time we're looking at. And so this one, we're still looking, hold on, 227.50. So if we're looking at the August 21, 227.50, 230. This one, oh, we're getting a 0.80. Let's make sure we get the 4 right there. Okay, there we go. So you can see 2 more weeks of time, but only 10 cents more. And so what are the pros and cons on this? Because we're really not getting that much more um, money for the time till expiration. In fact, if we go back and look now, I think I have both these. If I analyze this, I just want to check. I think we'll have both of them here. Yeah. So let's do this. What I want to see is looking at that time till expiration. This is just looking at the August 21. And while it has that range, the probabilities will start to change because this one, actually, I need to change the date here. This one didn't change, did it? When I went before. Here we go. There we go. That's a little bit better. This is what I want to show. That usually that does it automatically, but it didn't do it. I didn't catch that earlier that it didn't do it. This is actually because there's less time to expiration, there's not as much potential move, right? The more time something has, the further it can go. And so with less time, there's not as much potential move. And so this one doesn't have as much likelihood of going up above as it does when we're looking at the longer time frame. So it's, coming out to the 22nd. Watch that gray area grow. See that grow? Do you see that jump from here to here? So they change that time frame. And we don't want it up there, right? We want it tighter. So this is one of the pros of going shorter time frame is one, there's not as much time for it to move. It's already in a spot where if it just stays here, we'll make our money. And then 3, we're not really getting all that much more premium for the extra time. So kind of almost at additional risk. There's not a lot more coming in for it. What's the downside of that? Well, the downside is if it does go against us, it's kind of like an all or nothing, that we don't have that opportunity to just kind of wait and see if it can, like maybe someday it just kind of went against us a little bit and, we're just going to ride it out. We don't have as much opportunity to just ride it out and look for, to come back and make it a better trade, potentially. So there are pros and cons, but it's just important to understand what the pros and cons are and then weigh those out, right? How strong are your technicals? You're feeling very strong on the technical. If I'm feeling good about that. Maybe I incorporate that and say, it's bouncing off a real hard resistance. And so if it's going to drop, it should drop now and run with that, right? And so I could feel better about a short time frame. If it's just kind of out there floating, I'm just using probabilities, well, maybe, I don't feel as strong. So I'm just saying there's lots of things, lots of variables that we can take into consideration to help us decide, why one might be better than another. Let's go ahead and place this trade though. Let's go ahead and confirm and send this one. This is going to be the August 7th one. So send that one off. Again, that $70 and 180 that we're talking about. And hopefully we'll get filled on that one. All right. Okay, let's see. So let me just see what we have here on some comments. Thank you. Thank you, Cameron, for putting in the playlist for those short verticals. Yes, please click on that link, check out those short verticals. The NDX looks like it could fall again tomorrow. I mean, the NDX has been struggling. We go over there, NDX. This one actually clearly broke down, came back retested. Let's check this out real quick. We got a little arrow in there we gotta get rid of. Which one is it? Okay, there we go. Had to figure out what was causing that arrow. But on the NDX there, I have this symmetrical triangle in that it's already drawn. If I kind of take it from, it's a little bit far, but that's kind of the general idea is we're looking for it to go roughly that distance. And I activate that and take that to the breakout spot. This would be the potential target. And so it's generally the idea is the target would be right about here. And so there is some potential for it to drop down. As we can see, let me remove this. As we can see, I'm going to zoom in just a little tighter. Price action did break out, come down, come back, retest. And so that's fairly common on some price patterns is that once you get a breakout, it can, it doesn't always, but it can come back and retest. Not surprising then see it drop down. And so what we're seeing now It's just more bearish pressure, right? We see a little bit of climbing here on the RSI, but it's still on the RSI, overall bearish. In fact, we can go in there and maybe connect some of these highs and say, okay, this is where it seems to roll over. And we'll see if it rolls over here or not, which means it could just possibly rally back up to maybe a level up in here and then roll back. And so there's that overall bearish pressure. And, maybe that could help us on, some of those bearish trades that we have, right? What was the other comment I had in there? Gamma risk. Okay. And so, yeah, gamma risk is very important on this. Thank you, Duke. What is the gamma risk? Well, the gamma risk is basically that everything looks good initially. Maybe we look at those deltas and it seems really good, but they can change dramatically because that gamma can get really big getting into expiration. That last bit about expiration. Plus, another thing to think about is liquidity. The liquidity can dry up. And so a lot of times when we're buying, or should I say, entering a short position with, 6 weeks to expiration, we might get out with 2 weeks or a week before, where there's still some liquidity because it can really dry up, and it doesn't mean we're going to be able to exit at the price point that we want, and almost sometimes have to hold that through expiration just so hopefully expires worthless. All right. Let's see. I think I got them all. Like, all right, Surf Daddy got it more like straight trend trade. I like the management scale. And this is something I appreciate Surf Daddy kind of saying like, hey, this is more like a trend trade. There's two camps out there. It's probably more than two, but two main ones I'm thinking of, which is basically probability. So there are some traders that I've worked with over the years, and they don't even look at a chart. They just look at those probabilities, right? Saying what's the likelihood of this and that. And there's others that don't look at the probabilities, they look at a chart. I think it's good to actually blend the two, bring the two together and say, okay, well, what about, how about we pick out something that has a probability with the trend, with support and resistance, and kind of marry everything together and see if we can get it going. All right. Well, that is what we had to cover today. Thank you very much. Now, by the way, I'm not going to be here next week. I'm actually going to be flying out to Orlando. So, hey, anyone here in the Orlando area going to the the workshop that we're having in Orlando? If so, please come up and say hi. It'd be great to see you. I always enjoy meeting you. So please, yeah, do come up and say hi. But with that, I will let you go. Thank you very much, Cameron, for taking care of the chat. You did a great job helping you out. Richard Duke, Surf Daddy, Mary, others, take care, and I'll look forward to seeing you in a couple weeks. Okay, see ya.